I'm Alan Rohrbach, President and Lead Analyst at Capital Markets Advisors, Rohr International. We are in the clarity business. Now that's a fairly audacious statement considering I'm here on Ticker Talker where there's so many other talented traders and analysts who are also assisting people with achieving greater insight and clarity on their market involvement. The reason I say we're in the clarity business, though, ours is a longer term sort of vision of the market clarity. That is because we go back a long way. There is our beginning in the markets just over 50 years ago, and this means we started at the old mercantile exchange. And it was quite a long time that we've been at this, and we saw a lot of things on the markets. There's the macro background. We are macro technical, and the macro background has to do with understanding the drivers of the market, ultimately why the market ends up where it does, but also the technical picture. As you can see here, even our recent intermediate to long-term view extends back to early 2016, where the current extended bull market in the US equities started. And ultimately, we have all manner of projections we'll discuss in a bit more length later, but we understand the macro technical, how the macro, the fundamental drivers, whether they're exigent factors like the current COVID-19 serious impact, or the classical economic central bank and government policy influences, we have a great understanding of how that works from having lived through so much of it, and we're studying the market from early days. So indeed, going back a long time ago, well, not really quite that far, but when we landed on the floor at literally the old CME, we were runners when you were still delivering orders to the trading pit on slips of paper that had been taken at the order desk, and we were running in, giving them to the brokers who were filling paper orders. And you talk about high-speed, quote, dissemination now. Well, high speed back then was how quickly a broker who had just made a trade could shout the last quote up to folks on catwalks who were marking them on chalkboards. So we've seen the markets come a long way, and we've developed a long way along with them. And one of the key elements that we see here is that those various technical factors that we talk about are things in which we were mentored back at the old Merc. It was a wonderful, extremely dynamic learning environment because the exchange and the existing brokers, the senior people in the commodity futures business at the time, before there were financial futures, it was agricultural and metals, and they were happy to share what they knew, some great, some not so good. But we learned a lot about how to view the fundamental influences. And along the way, technical analysis was having quite a surge in the commodity exchanges, less so in the equities, where they were still looked down upon to some degree. But we had very good mentors to whom I am forever grateful on their degree to take us up through the learning curve. Now, initially, this was on very short-term charts. You're watching a longer-term history and chart projections here. We started watching pork bellies. There were no electronic charts at the time. We were keeping point and figure charts, X's and O's on pieces of paper, so we could track the swings. And my idea of a long-term trade at that point was if you got into something in the morning and had seen a swing in your direction by lunchtime. That's evolved quite a bit. Again, thanks to those mentors who took us up through bar charting, all these open, high, low, close, incremental entries on this chart, pattern analysis, including the trend lines and patterns, and we'll get into more patterns shortly, and the channel projections, which we find very useful. We'll have more to say on those in a little while as well. And the congestion areas where the markets tend to have left previous highs and lows that are, for their, just by the fact they occurred there, of some significance. You can see the moving averages running through this chart, shorter term tracking along with it, longer term trailing, that's the 9, 13, and 41 week moving averages. And we also use oscillators. We had used cycles for quite some time, but various relatively recent, across a broad history, relatively recent market developments meant cycles are not quite as useful as they used to be at one time. So here we are, and having to ask ourselves, you know, how did all this come about? The macro technical, the combined view. Well, for that, we're going to flip over to a offering that I have on Ticker Talker. Under my newsletters, there's a Rohr macro technical perspective. This is articles, videos, and eclectic posts that encompasses a lot of perspective. This goes back through letters we've had published in the Financial Times, some very good, relatively recent, from last October through early March, relatively recent video interviews at the CME with Price Futures Group's Phil Flynn, and other extensive perspective, the Sherlock Holmes market psychology. This comes from, I don't know how many Holmes fans there are out there, but good market analysis is very much akin to detective work. And in The Sign of the Four, Holmes says to Watson, eliminate the impossible, and whatever remains must be the truth, however improbable. And it's a lot like that with the markets, where nothing's impossible because the markets can do whatever they want just because they want to do it, but you can eliminate the highly improbable, and then you end up with what is most likely to occur. Whether they realize it or admit it or not, a lot of seasoned traders have a good sense of what's coming next from what they discount as not really likely being very relevant at a moment. We'll get back to more of that later as well. But the whole technical and fundamental mix, the macro technical, comes out of an old clash between, there used to be strict fundamentalists who said, well, why would I look at any of that garbage on lines on pieces of paper in your silly indicators like moving averages? I can know from supply and demand, historic retro testing, where the market's going to go. And on the other side, you had the hardcore technicians who would say, hey, we've got these various market levels, we watch how the market acts, and that's all we need to know, which is quite a bit in its way of what some of the technical algorithmic traders even do to this day. But for broader trend, not short term, but for broader trend analysis, it became obvious back into the early 1970s that the old pure fundamental wasn't working because of the degree to which the US government was detaching itself from the gold standard. And you'll notice this is technical versus with a question mark fundamental, because they're really two sides of the same coin. And I don't care whether someone says they are a diehard fundamentalist or an extremely rigid technician. All trend analysts are trying to answer the same questions. Which way are they going to go? When is the move going to start? And beyond that, how far might they go? Price objectives as such. And there are even instances where you have an idea how fast they're going to get there. And in that regard, classic fundamentals were very useful for a long, long time because you had a stable economic, global economic environment. But in the early 1970s, the US ditched the gold standard, got out of the old Bretton Woods currency fix system. And therefore, the dollar being allowed to free float did two things. One, it was a great benefit insofar as Leo Melamed and other enlightened people with the mercantile exchange and in academia convinced the US financial regulators that the value of a currency is a commodity. It was a quantifiable and tradable value, and therefore you got the international monetary markets. That was the beginning of all of us becoming aware of this wider world beyond soybeans and wheat and pork bellies and cattle. What we also found, though, is that the actual price movements in the markets meant that things were underperforming or overperforming, and it was simply a matter of the prices of everything from soybeans to treasury bonds might have a supply-demand situation that remained an influence, but inflation, deflation, and currency realignments started to play a much bigger role. And it became the case that, globally oriented traders could start asking, hey, am I trading steel or soybeans priced in dollars? Or am I trading dollars that are merely filtering through into being expressed in steel and soybeans? So that's the message there, that macro technical, with the technical picking up prominence, was there because in addition to having a good fundamental idea of what supply demand was doing, now you had to have an idea of whether the external global influences were suppressing or exacerbating a given trend. And knowing the technicals, when the market goes between these levels, the market is communicating with the price changes, but you have to put them in context. Technicals are kind of like the Rosetta Stone, where the market's talking to you by holding lower after a negative report, but then coming back up through the level it was at. But you need to be able to speak the language, and that is understanding the technical trend evolution. So now we'll head back to our presentation, and we can look at an historic example that's going to be relevant for what we're going to discuss about the recent and current developments in the S&P 500. Now this goes back to 2007, the tops in the summer and fall, into the holding into early 2008, and the attempted rally back into April and early May of 2008 that left the market stalling. Now, again, the technical factors, the broader context here was the housing and credit bubble were starting to lose all their momentum and getting ready to readjust for significantly overpriced housing and extremely bloated credit. Now, what we had here was the market that had bottomed out into somewhat below the low 1400s, maybe about 1430 or so on a stabilized basis, and had left an upside reversal back into December of 2007. That reversal was from the 1432 area. And if you didn't know everything that was coming next, you'd say, okay, the market's had a nice little correction, and this bottom means that's it. But what happened into January of 2008 is the market knocked out that particular bottom and the 1430 congestion, and that began the broader downtrend into 2008 that ended up with the market crash out in October. But long before that occurred, and this is a very much more stretched out trend than the hyper compressed, hyper volatile COVID-19 market we're dealing with now. But what happened was, after it left lows in about the 1250 area or so, both into January and March, it rallied back up. But it ran up against the 41-week moving average. That's our proxy, because we like looking at it on a longer term time frame, the 200-day moving average so many people follow. You can imagine looking at this on a weekly chart. I mean, this is the better part of a month of stalling into an area, but not being able to break back down. In its way, it was very frustrating. But also what we know is that unless it was above the 41-week average, the trend was still down. And once it slipped back below the 9 and 13-week averages, indeed, the overall downtrend into 2008 that ended up with the much worse activity out into October resumed. And this is important for the confluence of factors. When we look at macro technical in general, is a confluence. It's how the various fundamental factors are coming together to create price movement. And on the technical side, it is how the different types of indicators, the moving averages, trend lines, pattern signals like this up closing price reversal out here in December of 2007, how they all come together. And look how you could see the focus of all that into January of 2008. And again, the rally back to this congestion, as it's known, in the 1430 area, retesting the failed upward signal, and right into the trend resistance on the long-term average. So with all of that said, we can move forward to a more recent assessment. Now, this is on the daily open high-low close. This gets back to the confluence we wanted to study on the current rally up. Now, this only goes through late May. This is to a week ago Tuesday in the May 26th, but you can see the sharp rally higher. The macro factor on the breakdown below 2,600, we'll highlight again on the weekly chart, was the worries about no relief package forthcoming from the U.S. government. And once that became more apparent that that was indeed going to occur, the market pushed back above the old 2,400 area. The secondary package, looking like it was going to come through, pushed it back above 2,600. Now, in its way, this was a fairly sharp rally, and projecting channels is an art. You use how the market topped on the upside, the trajectory of the uptrend as designated by the highs, and go back and project off the relevant low. Now, this looks like a line hanging in space, admittedly, but this is the classical way to do this that we know from the early 70s from our Edwards and McGee technical analysis of stock trends. So here's your channel. What happened with this idealized channel? Well, the market was nowhere near it after it first topped, but working its way sideways, it finally broke down about 28.20. Well, there was something else going on by the time it worked its way sideways, and that is a head and shoulders pattern. So here's your left shoulder, kind of a complex double shoulder, sell off from there, push to a new high, gives you your head, and holding above the previous low gives you an upward sloping trend line that is known as the neckline. After the right shoulder, the next rally fails short of the top of the head. You've got shoulder, head, shoulder, and your down break was, lo and behold, 28.20. So when we take these and overlay them, we had a confluence of technical factors. We had the down break from the channel at the same point in time and the same price level as the down break from the head and shoulders. Also note that you had the moving averages that the market had mostly respected, especially the 18-day average on the way up. It was finally closing below as well. Now, all of this, one might think, should have meant this market had topped, left down breakout, below the averages, with multiple down breakouts. It should be bad. But a very smart man who I was collaborating with at one point, when I was working with one of the major data providers on their technical analysis package, he said to me, when I just asked him what was his broader perception of technicals, and he said, and he was a technician as well, so I was almost a little shocked by the first part of this, but impressed with the second. He said, well, technical analysis indicators and technical signals won't tell you which way the market's going to go. Okay, but he said immediately what they do give you is a price level and a point in time where the market should be doing certain things. And it's up to you, from your experience as an analyst or trader or portfolio manager, to ask, is this following through? Because the other thing we know, digressing into a little bit of a lesson here, the other thing we know is when the market has failed to follow through on a well-defined signal in one direction, it tends to reverse course and end up trending in the opposite direction. And that is exactly what happened here. Pushing above the high of the right shoulder meant that this was going to end up making a new high above the head, which it did, even going back to a week ago Thursday, and pardon me, a week ago Tuesday. And ultimately now, where has it ended up? It's ended up above even higher resistance. But you ever get one of those, we've got these factors, one of those TV commercials where they're trying to sell you something for $29.99, but near the end they go, but wait. Well, here again, but wait. This was also a sideways congestion range. Some people call this a rectangle, relatively equal lows and equal highs. So this is a fresh up break headed toward the higher key resistance at 30.30. Now we can go back to our weekly chart and flip over to that in order to see that 30.30 was the old multiple highs out of last August and October. The market pushed through by early November. And we can also see that there was a down break from this intermediate term channel off the lows in 2018 at 29.70, and the 41-week average was right about the 3007 area. So this is through last week, Friday, and by Friday of last week, the market had pushed up above 30.30, trading up at 30.42, which I know is not so easy to see here. I don't know why I keep losing my cursor. You'll pardon me if this thing is jumping around, but at points I can't see it. And 30.42, and that meant, gee, the market is out above this key area. Remember the 41-week average from the 2008 example? It's out. Now, that doesn't mean it's a sustained bull from here, but it does mean, based on the way it went up, there's just not much between 30.30 and the congestion on the way up from December into the highs in February and the last pullback low in early February, about the 3,200 area. So far, it's made it up to about 31.35. So it's reasonable to say these bigger technical levels that are confluences of factors, the inability to stay down below 28.20 going back a couple weeks ago, the ability to push up through 30.30, this is where you get your $100, $150, $200 moves in the S&P in this kind of volatile market. But this was also useful back in other markets when things were looking rosier, back above 30.30, and the market was pushing up, where you can look for the next $40 or $50 trend move in the S&P 500. So I see that my time is getting a bit short here. So again, to summarize, macro, technical. You need to know the forces that are driving the market. Those ultimately end up where it's priced, and the psychology develops around that. But you also need the technical, because the market that I'm not that friendly toward, I think there's a lot of hurdles and headwinds against the U.S. economy. But once it's above 30.30 in the current time frame, as W.D. Gann once famously said, don't fight the tape. Once it's above 30.30, I can be bearish. I just know I can't be short unless it fails back below 29.70, or until maybe it gets up to 3,200 and shows me something else that's more encouraging for a negative view. And with that, we can flip over to this guy behind me, over my shoulder here, the fiddler. And that is Marc Chagall's 1924, The Green Violinist, one in the series of Chagall's Fiddler on the Roof painting, headed back to his younger days in Russia. And the fiddler is a great metaphor for capital markets analysts, traders, and portfolio managers. Here's someone who is plying a very exacting trade on an unstable footing. And of course, in our case, the exacting trade is the analytics. Whatever you may be doing, whether you're looking for the next $1.70 in the S&P 500, or you're trying to figure out the next $170. And the unstable footing is the markets, which, as we've been reminded again recently, can shift at any time, for any reason, to any degree they feel like shifting. And that's about it. And I hope you've enjoyed the show. And we look forward to getting together again sometime soon. In the meantime, good hunting out there.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop platform into the hands of its users who are on the go. Ticker Talker connects novice and advanced traders with industry leaders who are providing real-time trading content throughout market hours every single day. The Ticker Talker app allows traders to follow and get real-time push notifications of trading leaders' trade ideas, all while on the go. Ticker Talker leaders host interactive live trading rooms which provide all-day coverage of their trading ideas and methods seamlessly with social chat for real-time feedback from the expert community of Ticker Talker's powerful user base. Set up and/or subscribe to automated trading strategies to mimic the decisions made by trusted professionals automatically. Powering up your trading AI has never been this easy. We focus on intuitive trading efficiency so you can focus on what matters most in your life. The world's most powerful trading technology is now in the palm of your hands.
Let's bring in Stephen Kalajian, who's going to help us continue to analyze what we saw in broad equity indexes over the last 5 days, as well as a couple stocks that he's got his eyes on. Stephen is the chief market strategist and co-founder at Ticker Talker. Firstly, on the broad macro perspective, do you look at the sideways action we've had as a slowing of the rally and a slowing of the momentum, or just an uncertain pause?
I think it's the slowdown that we're seeing is more or less a consolidation here. I think we're probably headed just a little bit higher before we top out short term, and then head lower into the summer.
So what will be telling